Folks, we have to have a conversation about what's called the 60/40 portfolio. For decades now, I've been hearing the pundits on CNBC, Bloomberg, and others talk about the 60/40 portfolio like it is the only thing that we need to be thinking about. I want to have a conversation with Taylor from Life Goal Investments. Let's define what it is so we're all on the same page. And then talk about, is the 60/40 portfolio dead? Because it's had some rough years here recently. Taylor, how you doing, bud?
I'm doing great. I'm here to tell you that the 60/40 portfolio might actually be back after being dead.
So it's a zombie? It's come back to life?
Yeah, exactly right. Yeah, so we'll discuss that. But 60/40 is the first number is your allocation to stocks. Your second number is your allocation to bonds. So 60% stocks, 40% bonds. And the way the market looks at it is they oversimplify and they say 60% S&P 500, 40% Bloomberg Barclays aggregate index. And that's a mouthful, but that is your S&P 500 of bonds. It is all investment grade bonds, mortgage-backed securities, asset-backed securities, treasuries, and corporates. So that's what the 60/40 is. And in 2022, now let's give some context as to what was playing out in 2022. We had all just been pumped full of insulin shots, which are stimulus checks. And then we also had Russia invade Ukraine, driving up oil prices and just shocking inflation higher. So we're all out there spending like drunken sailors because we've gotten stimulus checks. Oil prices are sending things through the roof. People are going on vacations regardless. And what you have is inflation just ripping. And so inflation ripping is an environment where this generally doesn't play out, but stocks and bonds simultaneously sell off. And this happened in the 1970s, and it happened again last year or I guess it's now 2 years ago in 2022. Okay. So you had stocks, being the S&P 500, being down 18.19. Okay. The NASDAQ was down 32.33. On the other side, you're like, all right, well, if stocks are getting torched on one side, bonds are going to do well on the other side. They didn't. Prior to 2022, the worst year ever for bonds, that index I spoke about, was down 2.94%. That was in 1994. In 2022, it was down 13.02%. Just a smooth 4x multiple.
Ouch.
Leading 2022 to being the worst year since 1937 for the 60/40 portfolio.
Again, 2022 was the worst year for the 60/40 since 1937.
And obviously, as I speak about that, so you talk about the S&P 500 being down 18, NASDAQ down 32, 33. And so those are not the worst year ever for stocks, obviously, right? In 2008, the stock market was down 37.5%. At its peak, it was down 49 that year. But on the other side, the Bloomberg Barclays aggregate in 2008 did what it normally does, which was the yin to the yang. In a recession, stocks will rally. Almost indefinitely, high-quality stocks rally in a recession. And so in 2008, you had a positive 5.5% return for the bond index. So it was the bonds that crushed the market, the 60/40, more than anything else did last year relative to history.
Got it. Okay.
And I say last year, I mean 2022. So don't let me misspeak there.
So 2022, 60/40 didn't work out. Cash was a great investment, obviously, in 2022. What happened in 2023? It just finished. How'd those numbers look in 23?
23 came back. So you had another relatively solid year. So if you look at the S&P 500, it was up 25-ish%. I don't know. That's an off the cuff number. Don't quote me on that. And then the bonds on the other side were up 6 to 7%. But at some point throughout the year, the bond index was down 7% in 2023. And then what you had was just a gargantuan rally in stocks and in bonds over the past 3 months, when the market started to say, okay, the Fed is done cutting, or the Fed is done raising rates. They're going to cut rates. And you had both stocks and bonds just go to the moon very, very quickly. And that had the rally of the 60/40 coming back. So I don't know, off the cuff number, 25% on the one side, 7% on the other, maybe you're up 12, something like that. Or no, probably more than that, 15, 16, somewhere in that ballpark.
So now as we kind of look back over the last 3 or 4 years, obviously with the grain of history since the 70s all the way back to 1937, is the 60/40, I mean, is it back? It, just had a rough year because everything had a rough year in 2022.
Yeah. So full disclosure, I don't love stocks broadly right now. Right now, if you look at the broad index, the S&P 500s trade at a price to earnings multiple of about 20 times on a forward basis, which puts in the top 10 percentile of valuations where stocks are getting more and more stretched. It's in the top 10 percentile right now. I do like bonds on the other side, because what you've just had is, you look back 2 years ago in 2022, the return pattern for bonds were asymmetrically negative. Why? Because bonds were yielding, like a 10-year treasury is yielding sub 1%.
Yeah.
And at the same time, if the Federal Reserve raises interest rates immediately, or, and interest rates and bonds have inverse price relationship. So as the Federal Reserve raises interest rates, if you're only at a 1% yield, you're going negative extremely quickly.
Right.
Whereas right now, the 10-year treasury is at 4, it was just at 5. And so now you have this buffer in the coupon, even if interest rates were continuing to go higher, which is not the expectation by the market or the Fed for that matter. You have a much bigger coupon there to cushion the fall on the downside. Now, what's expected out of the market this year is the market's pricing in about 5 interest rate cuts. So call that a 1.25% fall in interest rates. The Fed is saying 3 cuts, being 0.75%. So let's call it 1% fall in interest rates. When you look at the broad sectors within the bond market, whether it's treasuries, 2-year, 10-year, 30-year, et cetera, down the line, a lot of investment grade corporates, municipal bonds, floating rate debt, et cetera, a lot of them have double-digit return profiles if you get a 1% reduction in interest rates.
Yeah. Since we're talking about that, Bill Ackman's going to go down as calling the top again. Obviously, you've seen this, right? He was short the treasuries before the big run up. He flips. That was the peak. And now I think he went long. So he's sitting on a gains both ways, I think. It's pretty good timing.
He's played it really well. Yeah, I think that, like the stock market, the bond market does the same thing. So the bond market's been a lot more violent than the stock market has been over the past couple of years. The stock market has, kind of grinded higher throughout 2023. The bond market had massive movements upward and downward in yield. And the shocking thing was, coming into 2023 rather, the interest rate in the 10-year treasury was something like 3.9. At the end of 2023, it sat at 3.9. It just round tripped, but it was a violent cycle. It came down, then it went all the way up to 5%, and then it came screaming down again. So it's been, real violent movements. And if someone played it like Bill Ackman did, obviously with those violent movements come a lot of ability to make money. And that's one of the things, like, we talk a lot about on our channel, like, hey, guys, let's utilize bonds and stocks in conjunction with each other, because what you can do is, like, everyone's like, hey, I'm a young investor, and therefore I want to be aggressive all in stocks. Well, right now, when you look at the S&P 500 trading at a 20-time price to earnings multiple, history says when it trades there the next 5 years, 5% return is what the expectation should be per annum. That's half of the long-term average. I just talked to you about bonds. If we get a 1% reduction in rates, that's double-digit returns in bonds. What people don't understand is, like, listen, the reason that the Fed is, saying that they're going to cut interest rates is because inflation's coming down. Likely inflation's coming down because the economy is starting to roll over a little bit. If the economy rolls over and we enter a recession, regardless of how mild it is, stocks are priced right here. They're going to come down. Bonds are going to appreciate. Guess what you call this? This is dry powder. And then you can sell this at appreciated asset levels and buy this, which is your risk on asset, when it gets more and more valuation cheaper, if you will.
Yeah. I love this. I love this conversation. The 60-40 portfolio is back. I think it helps a lot of people sleep at night. 2022 was rough, but it was rough for lots of things. And then again, shout out Bill Ackman for calling that trade. He
No
nailed
doubt.
that one pretty quick.
No
He's had
doubt. No doubt about
couple
it.
of good trades. Yeah. Taylor, where can they find you?
Yeah, find us at Life Goal Investments. We're on both Instagram and TikTok. Again, our handle is at Life Goal Investments.
Awesome, buddy. Thanks again.
You're the man, Michael. Thanks.